In 2024, the U.S. federal deficit was an astounding $2 trillion, ranking it as the highest in history, excluding the COVID years of 2020 and 21. Our national debt is now over $36 trillion. Of course, paying interest on that size of debt would be a heavy burden in a low-rate environment. It now poses greater challenges as rates have risen sharply. Debt service is projected to be over $1 trillion in 2025. A problem the new Treasury faces is that the option of concentrating bond sales at the shortest part of the curve may be less attractive than in the previous 2 years because the potential for exhausted demand, due at least in part to the previous Treasury's pattern of selling. That leaves the necessity for selling longer-term bonds to raise money. The problem here is twofold. Over the last 18 months, several auctions of long-term bonds have been met with disappointing demand. This has been interpreted by some as the market scolding the U.S. for excessive spending. The second part of the equation is that the increasing issuance coupled with tepid demand has been a major factor in pushing yields even higher. In the last 4 months, 10-year yields have risen 130 basis points and 30-year yields 100 basis points, and both of those rates are getting precariously close to 5%, a level seen only once before since the 2008 financial crisis. There are a couple of options for managing the potential oversupply of treasuries, but none come without risks. The government could drastically cut spending and risk a recession, or the Federal Reserve could assist with bond purchases, which of course runs the risk of devaluing the currency.